In our last video, we uncovered how compound interest can grow your money while you sleep. But today, let's talk about something just as powerful: ETFs, or exchange-traded funds. If you want to grow wealth passively, without checking stock charts every day, this is the tool you've been looking for. ETFs are like baskets filled with dozens or even hundreds of stocks. Instead of betting on one company, you invest in a whole group of companies at once. You're not just buying Apple or Amazon, you're buying a tiny piece of all of them, instantly. That means one company's bad day doesn't ruin your portfolio. That's diversification, and it's built in. Let's break it down. Imagine putting all your money into one company like Tesla. Now if Tesla drops 20%, your portfolio drops 20%. Ouch. But if Tesla is only one slice of a 500-piece pie, then even a big drop barely moves the whole pie. That's what ETFs give you: built-in risk reduction. One of the most well-known ETFs is the S&P 500 ETF. It tracks the 500 largest publicly traded companies in the US, so instead of choosing winners yourself, you're investing in a slice of the American economy. That includes tech giants, consumer brands, banks, energy companies, you name it. Historically, the S&P 500 has returned about 7 to 10% per year on average, adjusted for inflation. That might not sound flashy, but over decades, it's huge. If you invest $10,000 and leave it alone for 30 years, you could end up with more than $80,000 without doing anything. And that's without trying to time the market or predict trends. This kind of long-term return isn't just a theory, it's based on nearly a century of market data. Through wars, recessions, inflation, and political chaos, the market always recovered. That consistency is why long-term investors trust the process. There are two kinds of investors: the stock pickers, who try to beat the market by choosing individual stocks, and the passive investors, who simply ride the market over time. Here's the kicker: most active investors fail to outperform the market over the long run, even the professionals. ETFs let you be the second kind of investor, the quiet winner. Many active investors fall into emotional traps, buying high when excitement peaks and selling low out of fear. They chase trends, follow headlines, and try to time their moves. Passive investors, on the other hand, stay the course and avoid costly mistakes. But how do ETFs actually work? Well, financial institutions buy the actual stocks that make up, say, the S&P 500. They then package those into a fund, and that fund issues shares that you and I can buy. When you purchase one share of the ETF, you indirectly own all those companies in that fund. You don't get voting rights, but you do get access to the performance and dividends. ETFs are especially great for beginners. Let's say you're starting out with $100 a month. That's more than enough to buy into an ETF and own parts of companies like Microsoft, Netflix, and Johnson & Johnson instantly. You don't need to study balance sheets or earnings reports. You just pick a broad ETF and stick with it. Here's another win: low fees. Most ETFs charge very little to manage your money, usually between 0.1% and 0.3% per year. Compare that to mutual funds or wealth managers who may charge 1% to 2% every year. Over time, that difference really adds up. Let's say Liam and Emma both invest $10,000. Liam chooses an ETF with a 0.2% fee. Emma picks a mutual fund charging 1.5%. Fast forward 25 years, both growing at 7% per year. Liam ends up with $52,000. Emma, just $42,000. Same returns, but fees took a serious bite out of her wealth. Do ETFs pay dividends? Yes, many do. If the companies in the fund pay dividends, the ETF collects them and passes them on to you. You can choose to take that money as income or, better yet, reinvest it automatically. Reinvesting allows your dividends to start earning their own dividends. That's compound growth in action. There are tons of ETF types to choose from. Some track large indexes like the S&P 500 or NASDAQ. Others focus on sectors like healthcare or tech, or regions like Asia or emerging markets. There are even thematic ETFs, like ones focused on clean energy, cybersecurity, or artificial intelligence. If there's a market, there's probably an ETF for it. Here's a technical but important point. Some ETFs are physically backed, meaning they actually hold the stocks inside the fund. Others are synthetic, using financial contracts to mirror the performance of an index. For beginners, stick to physically backed ETFs. They're simpler and more transparent. So how do you actually buy one? Easy. Just open an account with an online broker like Fidelity, Vanguard, Robinhood, or Charles Schwab. Search for the ETF by its ticker symbol. like VOO or SPY, ClickBuy, and that's it. It's like buying any regular stock. Most platforms also let you automate your investments. Set up a recurring monthly contribution and invest the same amount each time. This not only builds discipline, but also takes emotion out of the equation. You're not guessing when to buy, you're just consistently showing up. This strategy is called dollar cost averaging. When prices are high, your monthly amount buys fewer shares. When prices are low, it buys more. Over time, this evens out your cost and reduces your exposure to short-term market swings. But what about crashes? Should you sell? Absolutely not. Every market crash in history has been followed by a recovery. The people who panic and sell lock in their losses. The people who stay calm and keep investing often come out way ahead. Crashes aren't the enemy, emotion is. That's why it's so important to prepare your mindset in advance. Know that volatility is part of the journey. When it happens, you'll recognize it not as a threat, but as a natural phase, one you've already planned for. Now, what's a great first ETF to buy? Many experts recommend starting with a broad global ETF, one that includes companies from all over the world. The MSCI World or FTSE All World Index are great examples. With just one ETF, you're investing in thousands of companies across dozens of countries. What about taxes? Yes, ETFs are subject to taxes on dividends and on profits when you sell. But the good news is ETFs are typically more tax efficient than mutual funds. If you're investing through a retirement account, you might not pay any taxes until withdrawal. So should you just ditch individual stocks? Not necessarily. If you enjoy researching companies, it's okay to own a few stocks. But make ETFs the foundation of your portfolio. Let stocks be your side project. ETFs should be your engine. And do ETFs really work long-term? Let's look at the facts. Over decades, ETFs tracking the S&P 500 have weathered dot-com crashes, recessions, pandemics, even 2008. They bounced back stronger every time. That's why even Warren Buffett recommends ETFs for most investors. Let's recap why ETFs are such a smart choice. They're diversified, they're simple to buy, they're low cost, they're tax efficient, and they don't require you to be a financial expert. So what should you do next? Pick a trusted broker. Choose a simple, diversified ETF, set up automatic monthly investing. Stay consistent and patient, and most importantly, don't try to time the market, just spend time in the market. If you're in your 20s or 30s, time is your secret weapon. Even a small amount each month can grow into something massive over decades. If you're older, it's still worth starting. The best time to invest was yesterday. The second best time is today. You don't need to be young to benefit from ETFs. You just need to be realistic and committed. Even a 10 to 15-year horizon can provide meaningful growth if you stay invested and keep your costs low. And if you haven't seen our last video on compound interest, watch it next. It's the perfect companion to this one, and it shows how just a few dollars a day can turn into serious wealth. Thanks for watching. If this helped you, give it a thumbs up, subscribe to the channel, and stay tuned. New videos every week to help you invest smarter and grow your money.